AMD. We have some major developments in regards to AMD I got to talk about at the top of this video here today. So looking forward to getting into two things. One's very, very bullish in regards to AMD. One is like scary, bearish type sentiment. We'll speak about that in this video here today, okay? Then after that, we're going to get into housing starts and kind of the new data in regards to housing starts here. Very important to understand where the economy is headed over the next, I would say, 12 to 18 months as far as that goes. Looking forward to getting into this one. Gary Cohen used to be the president at Goldman Sachs. Speaking about his expectations on the market this summer, he says this summer the market is going to get soft. Ooh, okay. Looking forward to getting to that one. Solar stocks have fallen off a cliff, so I thought this would be a fun one to react with you guys in regards to solar stocks. This gentleman who's supposed to be like an expert on the solar industry, kind of his perspectives and opinions on this, which these stocks have gotten devastated. This goes to show you kind of where these stocks were at roughly at the end of 2022 versus where they're at now. Sunrun is down 78%. Enphase is down 88%. We have Solar Edge down 94%. These solar stocks have gotten absolutely obliterated. This isn't the first time I've seen this. I've seen this happen with cannabis stocks before. Also, I've seen this happen with 3D printing stocks many years ago. So sometimes you'll get a very hot sector, which is what the solar sector was a few years ago, and then it goes to nightmarishly cold. And that's exactly what's happened with these solar stocks. They've all been absolutely obliterated now at this point in time, right? By the way, I appreciate y'all joining me as always. Thank you so much for being here. One thing only I need from you guys, and it's for you to smash that like button. And that's it. I appreciate you for being here. If you want to subscribe to the channel, you can certainly subscribe. We are now over 98,000 subscribers, maybe somewhere around there roughly. I appreciate y'all for being here. I just posted this on X. I said, AMD, give me your 12-month price target. I said, my 12-month price target, you know what it is for AMD? $222, baby. Yeah, $222 for AMD. You guys know, obviously I'm bullish on the long term for AMD, but I do expect that stock to continue to heat up hotter and hotter and hotter as more and more folks go bullish on the stock as they see the numbers roll through, the guidance roll through. And so, if you want to check out what people are saying in the comments as far as that goes and what their opinions are on the 12-month price target, you can always follow me on X. That's linked in the description area of all my videos. So you can go down there. Also, my Instagram's linked there as well. It looks like 44 people in the past, since I posted that 16 minutes ago, have already commented. So if you want to put in your 12-month price target, we can always look back in 12 months and see who is the closest in regards to that. Okay, now let's start getting into these.
Let's do it. Beer never broke my heart, but certainly AMD has to many. I think it's time to turn that around, Courtney. Thank you for the list. Thank you for being here.
You're welcome, Michael.
So that's important right there, right? A Wall Streeter going bullish on AMD, right? And he acknowledges like AMD's broken a lot of hearts. The Wall Streeters are starting to turn. It's part of the process, man. If you're going to have a big bull cycle in regards to stock, it can't just be retail investors like myself and you guys, that see an opportunity with the company and are like, man, this is big. Like AMD's going to be huge over this next few years, right? It has to be the big money has to start coming in. The Wall Streeters have to start coming in, right? And so we had some analysts this past week start to go a little bullish on the stock. Now you start getting some of these Wall Streeter types start saying, you know what? I like AMD now, right? And you know why people are starting to get interested in AMD when it comes to the Wall Street side and the analyst side? I'll tell you why. The stock is starting to perform really freaking well. That stock bottomed back in April in the 70s, right? It's already up to 126 or so. So that's a huge pop in a very short amount of time. The better AMD stock price performs, the more the Wall Streeters are going to jump on this bandwagon left and right. Like all of a sudden this stock goes 150, 175. We're going 200 right after that. And once we talk about 200, we're going to be talking about breaking new all-time highs and going to 250. And so, you got to understand it's like a whole compound effect. The Wall Streeters, the analysts start turning a little more bullish. The Wall Streeters start turning a little more bullish. And that creates this price momentum. The company comes in. As long as the company comes in with great numbers, which they should do, Lisa Su and the team should come in with great numbers, great guidance. You keep the momentum going. More and more these Wall Streeters, hedge funds, analysts get bullish on it. It's just a whole snowball effect, and then the stock just continues to beast. And so when I say my price target, 222, obviously it's so hard to make a 1-year price target, right? I love to make my longer term price targets and run my projections on 1000xstocks.com. But 12-month price target, because I would not be surprised And I have no call options on AMD. So maybe this doesn't happen. A year from now, AMD is still 126, right? But it's near impossible for me to see that, considering how strong AMD numbers should be and how strong the guidance should be for this next several quarters. Like, I think their guidance even next quarter is going to be booming. And I think the guidance for the following quarter is going to be even better. And so, and then you talk about several of AMD's businesses that have been negative are going to turn positive in the back half of the year, in my opinion, as well. Like, there's going to be a lot to be excited around regarding AMD. But some people might say, hey, this is bearish. I'm sure you guys have seen in the past 24 hours or 48 hours. Amazon custom AI chip success might lead to greater market share. One of my big companies, one of my biggest investments, Amazon, right? What are they doing? AWS, successful training results with its custom artificial intelligence chips might help the company gain market share in the realm currently dominated by NVIDIA and, to a lesser extent, AMD. AWS plans to announce updates soon to its chips, blah, 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 right? Here's the deal, okay? In regards to Amazon, as an Amazon shareholder and as somebody that wants Amazon to succeed in regards to their chip ambitions, right? My opinion is they cannot catch NVIDIA and AMD when it comes to the best tech. And they're not really trying to do that. Amazon, in my opinion, what they're trying to do is have workloads that don't need the best of the best chips. They need chips that are powerful enough to accomplish what a particular company needs, right? And do it in a very efficient manner, a very energy efficient manner. Because it's kind of a waste. Let's say you're using like the most expensive NVIDIA chip or the most expensive AMD chip, but you don't actually need that chip because it's like you don't need all that power. It's a waste. It's a complete waste, right? And I'm sure some of you guys know that from even like, using a computer. Like, some people buy these, insanely spec'd out computers, and they never even use the computer for what, like a fraction of what they actually need it for, right? A car is a great example of that. Like, right, I got two cars actually in my garage that can go 200 miles per hour. The Model S Plaid is supposed to go 200, and my Ferrari is supposed to go at least 200. I'm never going to take those things to 200 miles per hour, right? It's way more powerful than I need. And so if you're a company and you need massive amounts of chips, what is the point of having the most powerful, most expensive chips? It's so inefficient if you don't need that. Now, there are certain programs, certain things, certain training developments, certain inference you need to perform that you need the best of the best chips. You want the best of the best chips. You want the MI350 that AMD has. You want the most advanced Blackwell chips from NVIDIA, right? Like, for certain applications, that makes the most sense. But for others, it doesn't. Not every company, not every business, not every service needs the most advanced NVIDIA chip and the most advanced AMD chip. And so that's where these sorts of custom chips come in for Amazon and can help companies run very efficiently, okay? All right, let's go into a way different subject now, and let's speak about housing and the economy, and then we'll get into the market talk.
Talk about it. I don't want to say nobody's building homes, because there's still homes being built.
There are still homes being built, just the lowest in 5 years. Yeah, definitely. So we got the May read this morning on housing starts and permits, and they were well below expectations. Let me break it down for you. Multifamily starts dropped over 30% month to month. This is a volatile monthly number, but we have seen a record supply of new apartment units delivered in the last few years, with more this year, so the development pipeline has been slowing down. Interesting, though, that permits, which are a future indicator of construction, are higher, and that's because the market is now seeing stronger demand and people staying in rentals longer. Why? Because they're not buying homes. You see that in the single-family starts number, flat for the month and down over 7% from a year ago. This should come as no surprise given the very low builder sentiment report we got yesterday and a weaker outlook from Lennar's quarterly earnings report Monday. The consumer is just not willing or not able to make such a large investment given high costs, high rates, and overall economic uncertainty. You see that also in the mortgage demand numbers. We got those this morning. Mortgage applications to purchase a home dropped again last week. They are 14% higher than this time last year, but the numbers are still historically low. And when you look at applications just for newly built homes, those were down over 4% year over year in May. And rates did drop a little bit last week, but really rates have been hovering in this very narrow range, just below 7%. And as everyone keeps saying, Brian, we are in the new normal of the mortgage rate.
Yeah. and the new normal seems to be fewer homes, the fewest in 5 years, being built. Diana Olick, thank you very much.
So this is where my frustration with the Federal Reserve comes in here, right? Because if you ever want to look at a healthy U.S. economy, the best thing you could always look at is, are people buying homes? Are people moving? Are people buying new homes? It's always the best indicator. Like, there's nothing I can think of better. You know, we could all walk around the mall and say, is the mall busy? We could all go to the airport and say, is the airport busy, right? And of course, the airport's always busy. The best indicator always is, are homes being built, man? Are people going to buy new homes? Because if people are going to buy new homes, a bunch of stuff needs to get fixed on existing homes. If they're building a new home, it creates massive amounts of jobs, right? People go buy new appliances. They go to Home Depot. They're going to Lowe's. They're doing all this stuff, right? Like, if you've ever been through the process of buying a home, you know it's a lot. And you spend a lot of money. Big money on the actual home, but then you spend a bunch of little money on a bunch of other random stuff, right? And so the Fed is in the situation where they don't want to cut rates. And it's like, you know, look at the housing market. The housing market doesn't say this is some booming economy right now, right? The economy is okay. You know, it's okay. It's no overheating economy. It's no, you know, booming thing. And so, you know, it's just like you get all this data points of like, they should be cutting, they should be cutting, they should be cutting, they should be cutting. They're just not cutting, right? And so it's a frustrating ordeal is the best way I could put it. It's a frustrating ordeal. Hopefully eventually they wake up and they get cut in here. But, you know, we also need all these treasuries lower. We need that 10-year to go a lot lower. Like, we need a 10-year to go into the 3s and maybe even the 2s, right? But regardless, I feel like the housing market will, you know, wake up a little bit toward the end of this year, a little bit more in 2026. And then I think the housing market will get healthy as 2026 rolls along, and then you get into 2027, 2028. So I believe this extremely unhealthy housing market we've been in where no one's moving, I think its days are numbered now at this point in time. I do believe it starts to wind down in the back half of this year, and then we start to get a little bit healthier in 26, a little bit healthier in 27, right? And then we get back to a fully healthy market where people actually can move their homes again, which, you know, it hasn't been like that for 3 years now at this point in time, right? This summer, the market's going to get soft, says Gary Cohen, formerly of Goldman Sachs.
It's good to have you.
Good to be here.
Should the Fed be cutting 2 to 2.5 points?
No. You know, as we've talked many times on here, the Fed is data dependent. And right now, the data, you know, is coming in, I think, better than people perceive that it would be coming. So there's this perception versus reality. The reality of economic data today in the United States, at least up to the last week or two, has been quite normal, quite ordinary. There's this perception out there that data is going to get bad and going to get worse. And we see that in a lot of the soft data. The polling data says that we could be heading towards a downturn.
There's a little bit more slowing than that, isn't there? Retail sales.
But remember, you and I had this conversation about retail sales.
You think it's
we believe, and I believe, a lot of big purchases were pulled forward prior to the tariffs. You know, people were very smart in this country, and then they saw big tariffs coming for automobiles, for washing machines, for appliances. They pulled those purchases back into April, May, into early June, and so that money was spent. That money was spent in the system, and we were surprised how strong those retail sales numbers were. So if you look at the last 3 months together, retail sales have been about normal. This is the reality of perception versus reality. So now that money's been spent, and we sort of talked about how we thought the summer might get soft. I think the summer is going to get soft because consumers have done the consuming they're doing. The Fed acknowledges they're at a restrictive place right now. I mean, they're not fighting that. But they see an employment picture that continues to be relatively strong. And they see an inflation picture that is sort of at or just above their target. So
if they're restrictive, here's my question. Why would you want to be restrictive when you're seeing, you know, and I went through all the data in my main channel video, if you guys didn't get to see it last night, financial education, right? I talked about stocks in that video too, but at the whole front portion, I spoke about the Fed. And I showed all the data points that all are showing inflation is not an issue. And yet the Federal Reserve, you know, thinks like maybe it's going to become an issue down the road. And it's like, well, then you're not data dependent. That's why I almost spit out my soda when I heard the man say they're going to remain data dependent. I'm like, what are you talking about? No, they're not. If you're looking at the data, you say you need a cut, you know. What about the housing market makes you say, yeah, we should stay restrictive right now? What about where CPI is, PPI is? I went through all that data points last night. GSG, right? Went through it all. And all it showed was the Fed should be cutting right now. There's no doubt about it, right? There's no reason to be restrictive right now. We have basically the Fed right now should be roughly around where CPI is at. CPI right now is 2.4-ish, 2.5-ish. Fed funds rate should be 2.5 right now. That's where it should be. Not 4.5, 2.5. That's 200 basis points down. Major change, right? That's where the reality of where they should be, in my opinion.
Do have the luxury of doing nothing.
For how much longer?
Well, that's what we don't know.
The only reason they have the luxury of that is because the market is near all-time highs right now. If the market wasn't near all-time highs, believe me, this Federal Reserve would be cutting. 100%. But since they get stock market, they're like, there's no need to cut soon. And it's like, dude, the market can shift like that. Like all of a sudden the market go down big, and then you're going to be cutting like crazy. And then that's going to look really bad because you're going to have the stock market tanking off a cliff while you're cutting like crazy. That's going to really freak people out. Come on, man. Big buy the dip opportunity when that happens, by the way.
What we're waiting for is perception and reality to potentially collide, or maybe they never collide. If we stay in this...
Yeah, but perception, like this man's perception and my perception are not the same.
Muddle through economy where we continue to create job growth and jobs stay relatively strong, and we do that without inflation, I think the Fed's on hold for the rest of the year. And so that would not surprise me to see the Fed sit at these rates for the rest of the year. Wow. I think more realistically, we probably see a little bit more weakness in the job market.
If he's right about that, which who knows, maybe he will be right. Like the Fed should already be cutting. They're not cutting. They're not interested in cutting right now. So would I be shocked if they decided not to cut the whole year? No, I wouldn't, because they're already doing what I think they shouldn't be doing anyway. So, it wouldn't shock me anyways. But let's be clear. Remember, I keep talking about this year reminds me so much of what year? 2018. I've been talking about that for months and months and months now at this point in time. It reminds me so much of 2018. And here we are almost getting to all-time highs. And if this is 2018, we should hit all-time highs within the next couple weeks here. And then we should blow through those all-time highs and explode until about September-ish. Then we could run into drama. And what happened in 2018 that sent the market down huge? The market threw a fit. You know why? The market wanted Jerome Powell to start cutting rates. And the Fed was holding out. And the market threw a fit. And everybody got real scared. All of a sudden, panic ensued in the market. And that December of 2018, we were on pace. I always tell people this, like you look back, there's articles on it. We were on pace during that December. I think it was up until like December 21st or 22nd. We were on pace for the worst December in the stock market since the Great Depression. That's how bad it was. Market just started tanking really in October, November, and it just got really, really ugly in that December time frame. Major drop. And we had potentially arguments of overvaluation at that time. Then people got worried about the economy and a bunch of other factors. And then they said the Fed needs to be cutting. And Trump was trying to put pressure on Powell to cut. He wouldn't do it. And so the market freaked out. I mean, gosh, it's going to be really freaky. If we hit all-time highs in this next couple of weeks and blow through those, right? And then we explode throughout July, August, September, it's going to be freaky, man. Like, it's going to be hard to not say this is 2018 and say we're going down to Chinatown come the fall time, right? And then, beginning of 2019, the Fed can say, okay, we're ready to start cutting, and the market bounces back. Like, it's just weird, man. It's weird how much this year's reminded me of 2018. Like, holy smokers, that ain't no jokers. And by the way, if you want to know what stocks got hit the hardest in that 2018 time frame that I remember, I'll tell you the stocks. It was a lot of the big techs. A lot of the big tech stocks. I remember Apple getting slammed. I remember Nvidia getting slammed. That was actually the first time I ever bought Nvidia. I think I even bought some in the public account back then. And the public account was like a new, fresh portfolio at that time. Man, I'm telling you, I remember the big techs. I remember Meta getting slammed, which back then they were just called Facebook. Woo! But honestly, everything was getting slammed. Like the S&P 500 dropped like 20 or 25% quick. But I remember the big tech stocks specifically. Man, were they getting hammered. So You know, if this is 2018, we blow through these all-time highs, boom, 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 drama in the fall. Don't be surprised if big techs get hit heavy come that time. But between now and then, if this is 2018, who knows? Like, Meta stock could go from 700 to 900 between now and then, right? And then fall from 900 to 700, you know, come the fall time, which would be a powerful drop, but, you know.
Yeah. I think we end up with one rate cut. I think the dot plot today is the most interesting thing we'll see. I mean, you know, Chairman Powell will have a lot to say, and I don't think we'll get a lot out of what he has to say. But the dots will tell us something. I think we'll see dispersion in the dots. I think we'll see dispersion from, you know, 2 cuts to 0 cuts.
You think they'll take away all cuts?
I think there may be 1 or 2 people that take away all cuts. There may be.
Because they're worried about inflation.
Yeah, they're worried. And so, but I think we're going to coalesce around one.
Did you hear that? Worried about inflation. Based upon what? That's an opinion. It's not data. It's like, well, Trump's talking tariff, blah, blah, blah. And something might happen. It's all opinion on what might happen. It's not looking at the data. Looking at the data saying, okay, here's all the numbers we have in front of us right now. Here's what it's all showing. Here's the trends. That's looking at the data. They're not data dependent. They're opinion dependent.
Between now and the end of the year.
Some of your former colleagues at Goldman just reined in their peak unemployment rate this year to 4.4. Right? They're not expecting any, even though I think their consensus on the back half is maybe payrolls get to 80K, 75K, something like that. Makes sense to you?
Yeah, no, it does. It's in line with what I'm thinking here. It's in line that we are going to continue to muddle through this economic situation. We've got some gives, we've got some takes. You know, we had this windfall of energy prices falling significantly since Inauguration Day. You know, I don't know if people have noticed, we're basically back up to Inauguration Day prices. You know, we've gone down and we've come back up to $20. So, you know, that the tailwinds of lower oil prices, which to me is one of the most important factors when you're looking at inflation, that has come back to the existing levels. So, look, there may be some more inflationary pressures in here. I think the employment market stays relatively strong. And it may allow the Fed to just keep sort of kicking the can down the road to the end of the year.
Yeah, you know, and there's plenty of things I don't agree with Trump on, you know, but I'll tell you one thing I agree with Trump 100% on. 100%. No question about it. Is I agree with Trump on his criticism of Jerome Powell and the Federal Reserve. 100%. He, you know, he's right on the button in regards to that. Like, and even you look at the Fed cutting last year, you could say the inflation picture looks even better now in regards to looking at the data than when they were cutting last year, right? And unemployment rate this year right now is higher than it was at this time last year. Like, you could say there's so many signals that say the Fed should be cutting right now. So when he criticized the Federal Reserve, when he criticized Jerome Powell, I'm like, preach, man, because 100%, like, they deserve the criticism, in my personal opinion right now, right? And they also helped exacerbate the insane inflation we all faced back in 2022, right? So they deserve the criticism for what happened there, and now they're just messing up on the other side. All right, let's talk some solar stocks.
Residential solar sector, which had already been under vast pressure because of consumer confidence, because of financing costs, so many other reasons, and now this. And I'm just wondering what happens in this sector. It's been re-rated, obviously. Is it enough? What happens to these stocks?
Honestly, this bill is bad business and it's bad policy. I mean, the reality is that the IRA was net generative of tax revenue by 2031, really starting to turn positive in 2028, and to the tune of $175 billion, according to the American Center for Progress. And ballooning beyond $500 billion of net tax revenue generation for the federal government by the middle of the next decade. So what the residential market is looking for now is a fix around really the leasing elements of the 48E credits, which allow for financing of systems at the residential level. And the reality is for utilities and consumer.
So Senate Finance Committee budget bill here. Residential solar tax credit ends 180 days after bill becomes law. Utility and commercial solar credits get phased out, fully expiring by 2028. Long-term, clean energy incentives remain in place for nuclear, hydropower, and geothermal.
Alike is that it's much easier to deploy dispatchable systems, which would be solar plus energy storage, at homes rather than building incremental distribution lines and transmission lines, which are expensive. They take a very long time. And so we're hoping that we'll see a fix. I agree that we're unlikely to see something with the reconciliation process. But right now, we're going to have to see what the rules are and then start problem solving from there as an industry.
So there's just like a lot of unknowns. As I understand it, for solar, a lot of you analysts out there thought that First Solar would be among the solar stocks that would be less scathed than the rest of the group with these tax credits ending. But at the same time here, the question mark is whether or not they can still get the stacked credits in manufacturing. You know, when will we have some resolution?
It was a big surprise to see what we saw coming out of the Senate last night, because we are seeing a material step down on an annual basis for the 45X credits, which are the manufacturing credits. And so for an administration that has touted reshoring and looking for manufacturing, where there's been some very significant investments, a lot of job creation for the solar industry, to the tune of 275,000 jobs in this industry, with a healthy portion of that being manufacturing jobs, to walk away from manufacturing, for this industry, just doesn't quite make sense. And I think that was a big surprise today. So First Solar obviously has some work to do around figuring out what they're going to continue to invest in this country, but there's going to be some jobs that aren't created. There's incremental investments for manufacturing in the U.S. that will not be made because of this bill, and we'll see electricity prices continue to go higher at an even higher rate.
So, Colin, not that it matters, but SolarEdge, I think, was almost a $400 stock 4 years ago. I think it closed at 16 today. The worst day on record. My question is there a winner in all of this? Is there the other side of that coin on the solar side?
Yeah, I mean, there's certainly names that do benefit. So we're looking at the utilities, the publicly held utilities that do win from this. You're going to see some of those folks like Nextera, and some of the other folks like Energy that have exposure on this space that are going to be net beneficiaries here. Certainly, we're seeing, some of the folks that on the construction side that can start charging higher prices here short term, because there's going to be a very big push to get construction done as soon as possible in the industry, are going to be able to raise prices to push these things forward. But the real loser are consumers, and really a lot of folks that have some very I think compelling jobs building the clean energy economy with this bill.
Yeah, and this is another thing that you got to watch out for in regards to the economy, for next year and the years after, right? Is, if you're talking about solar, a lot less folks getting solar over the next few years, right? That's less jobs created. At the end of the day, those panels don't build themselves and they don't get installed themselves. It all takes people with jobs to actually go do that stuff, right? And so, just all factors to kind of keep in mind there, right? And at some point, I think the market will start getting freaked out about a lot of this. If they see continuing a weakening demand for home building, for stuff like solar, like a lot of this stuff, man, it creates a lot of jobs. And, you start having that trickle, you shut that baby off. Is no bueno, right? All right, guys, appreciate you joining me as always. Thanks so much for being here. If you want to follow me on X, if you use X, that will be I'll put that linked in the description area down there. Pin comment if you're looking to apply to our private stock group, private wealth group, all that good stuff. And additionally, if you want to follow me on Instagram, that's always linked in the description area of all my videos also. Much love and have a great day.